the market's falling that I wanted to get across to you as well. So you can see the screen right now. This is something a client sent in. I showed in the last webinar as well. And this shows the biggest problem at the moment people are facing. They're sitting on a lot of gains. Then the markets have had a sharp pullback. The companies are quite volatile. These all happen to be companies I own as well. But this client, looking at one of our model portfolios, having selected these, now under the issue of, well, what do you do? And I explained there's several issues you do when in a market like this, which is volatile. First of all, you can just take the longer term view, which is you'll rebalance once a year. So if you've got 20 stocks, 5% in each, you'll bring them all back to 5% of your portfolio at the end of a year. Now, the pros and cons of that are obvious. The cons are an AMD could be up 244%. By the time you get back to rebalancing it, it's fallen all the way back. I'm not saying that's going to happen. I'm just saying it's a possibility. I was at London Tech Week yesterday at Olympia, and what happened? AMD were there, got a nice little cap. I thank them for the profits in the portfolio as well. Welcome everyone signing up and getting on at the moment. I can see you saying hellos and everything else. That's very good. I know it's at short notice, and yet we've still got over 100 people on within a few seconds of starting, and that usually doubles as we progress. So that's option number one. Rebalance once a year, bring it back down to 5% if you've got 20 stocks, 2.5% if you've got 40. Here's the next step. Now, if you want to be a bit more proactive, though this gets a bit more difficult, is if any holding gets to half or double its initial percentage of your portfolio. So let's say you start with 5%. If any holding because of profits becomes 10% of your overall portfolio, or because its drop becomes 2.5%, then you rebalance back up to 5%, all your holdings, okay? That's another trigger point. Now, the problem with that is the pros and cons of that is you might be overdoing it, over trading, takes up a lot of time to do. And then you'll only know in hindsight which of those two approaches I mentioned was the right one to do. The third, which is the most proactive of all and the most time consuming, and the pros and cons are obvious with this, because again, in hindsight, you might think, oh God, I wish I didn't go down door 3. The third one that you might want to consider is if any stock, let's say AMD, drops X%, you'll sell Y. So you say to yourself, I'm sitting on 244%, got a big fat gain. And I said, this is a client portfolio I'm showing you here, and the percentage returns they got. The amount of capital that you've got, they've got will all vary, but the percentage gains should all be the same amongst all my clients who are into these stocks, because they presumably got them all roughly around the same amount of time. So this client sent it in for that reason. Now, if it drops 5% from the high, 10%, 20, 30, 40, you will have a number you'll write down on a piece of paper based on your risk capacity, your desire to mitigate your regrets, not your belief you can see into the future or crystal ball gaze. Don't do that. You do it based on, if it drops X, I'll sell Y. So there you have it. 3 different approaches, all with their own pros and cons, all dependent upon how much time you've got to manage your portfolio, and all based not upon the ability to see the future, which you can't, but instead a process which allows you to go out and smell the roses instead of trying, and a professional process instead of trying to predict the future, which is the mistake private investors make and then get wrong-footed. So just to recap, all 3 of those processes, when the markets are high like this, and I showed this last week from one of the clients, number 1, you rebalance once a year, bring them all back to 5% or 2.5%, whatever the percentage original holding of all your holdings was. Number 2, if any holding gets above 10% or below 2.5% of your overall portfolio size, you balance that up and maybe jig some of the others, but more time consuming, and only hindsight will tell us which of those 2 approaches was better for you. And number 3, if drops X, sell Y, most time consuming of all. And again, you'll only know in hindsight which is the better one, but allows you to be a bit more proactive. So something like a Micron, a student might say, look, Alpesh, for my own risk capacity, I think I'll take my original investment out and let the rest of the money run. So yeah, you've got those alternatives as well. AMD, thanks Alpesh, we've more than doubled it. I'll take the original capital out, put that into other stocks, add it into my existing portfolio. Now that begs the other question. If you've got more capital, what do you do with your portfolio? Well, you can either add to your winning stocks, add to your losing ones, or add to all equally, such that they become more balanced towards your target weight of, say, 5% in 20 stocks. Okay, so if you've got an extra, I don't know, £10,000 comes in and you've got, for argument's sake, 20 stocks, then are you going to put 500 in each? Well, you might not if it's a micron, because you've already got an exposure in that. You might just top up the ones which are below your target weight of 5% in each, okay? So quite a lot covered there. But if I've got into more detail on this on campaignforamillion.com/blog, where I write a lot about these issues. That's campaignforamillion.com/blog, because of course, explaining this quickly over a webinar is one thing, but you can go into more detail there. So you can see it over there, and you can read a lot of those things which deserve a bit more detail, including if NVIDIA beats its earnings, why did the stock price fall? So trying to give you an insight into how it is we on the hedge fund industry think about these things, why we're thinking one step ahead. It's not about beating the earnings. It's about what is it that the market was looking at and how's it going to react, and therefore how are we going to react to its reaction, which it was anticipating. And that's also why we don't trade around earnings, because it gets a bit messy. And you can see over here quite a lot of information that we gathered and we put together to look to see how what journalists say is just simply incorrect. When they say, oh, it beat the earnings, but the market fell. They're guessing at what happened. So we look at statistics and see historically how it moved, not with a view to trade around those earnings, but with a view not to be surprised by any particular move. And as long as they fit within the normal historic moves, we're fine. A bit like your car. If it's running fine and there's nothing on the dashboard flashing red, then you're not going to take it in for a service. And similarly with an NVIDIA. Just because we're monitoring every bump on the road doesn't mean we're going to swerve and try and oversteer and everything else. It's just so we know there's no reds on the dashboard, and there weren't. So those kind of things go into great detail. And, you know, whether you've got kids or not, whether you want to do it for yourself, it's a really good way to learn, because I've written these with quite a degree of focus on the practicalities and the stuff you just don't get taught absolutely anywhere else at all. So that's at campaignforamillion.com/blog. which again has an article on rebalancing your portfolio. So the S&P 500, this is how it was historically. The reason I show you this historic image is that's the benchmark, that's the template, that's the ruler with which we measure where things are at the moment. And I've said to you in the past, we're either going to be at 1, 2, 3, 4, 5, 6, or 7. These are the only positions that we can be at. And depending on where we are on those cycles, the prices move accordingly. Okay? Now, for a long time, we've been at 1, rising, but overbought. Risk averse would stay cautious or stay out of the market. The risk neutral would add to winners cautiously because they're risk neutral. Okay. Risk loving will buy. Okay. They'll just buy the S&P. Now, there's a 70% chance of a greater than 10% drop in less than 6 months when we're at this position 1. And the next thing is what people are asking right now is, are we getting at position 2? Position 2, we're measuring it all on the average prices. Prices are important because that's what people are actually willing to pay. Journalist commentary is cheap. What you're willing to pay tells me a truth, that you're really willing to pay that. Profits are made on prices, the difference between the sell and the buy price. They're not made on what a journalist thinks or sells or a talking head yaks. That's why prices are critical, and that's why we look at what are actually the prices doing. Just like in an auction, somebody says, oh, I think that's worth a lot. Okay, will you pay for it? Oh, no. Well, put your money where your mouth is, and then we know you're telling the truth. Okay, and that's why prices are important. So have we gone from 1 to 2? That's what we need to know. And I'm going to show you the S&P 500 in just a second. In fact, I'll do it right now. There's the S&P 500 right now. Now, to my eye, whilst we've had these falls, and we're down only about 5.5%. And the S&P looks like it's flattening. Okay, I'm not going to try and read into the future what it means. What I will tell you is that earlier this year, it dropped double this amount, and people started panicking terribly. At the moment, what we have is it's not fallen below its own blue dotted line, its own signal line, which is a point at which we might start to get worried. And it didn't do it earlier in the year. It did it very shallow with the Trump tariffs. And that was a fall of about 21%, when quite a few people said, oh, God, I'm glad I got out. when it just started dipping, and we're not even at the just started dipping stage, which is about here. I'm glad I got out, and then they got back in a bit later. Some got back in at a lower price, some got back in at a higher price than they got out, but that's the insurance cost you have to pay if you do get out. Now, if you stay in, you're going to go through a 21% drop. So some do it half and half. They say, well, I'll sell half. And the danger with that is they sell half and they forget to buy back, or they buy back more expensive. So they say, well, I'll just stay in. And then they stay in and they get the Alka-Seltzer out because they're getting indigestion, because that's a 21% drop. Okay? Well, what should I do, Alpesh? Well, I can't tell you what to do, in the sense that I don't know how strong your stomach is. If you've got a strong stomach, you'd sit through it and you'd say, well, I don't think it'll be a sharp, long fall like 2022 was, like this was, where it took, 2 years to go back to break even, and it dropped 26%. Okay, I don't think, because those happen infrequently, Alpesh, and they happen when interest rates are rising. Well, the ECB raised interest rates today, but I don't think the Americans will. Okay, the short, sharp ones happen when periodically, it's just statistically, you get some other scare other than interest rates, like tariffs. 20% is bad. So you've got a choice. Either you're going to sit through it and get a heart attack, you're going to sell half and risk having to pay more, or you're going to sell all and risk having to pay more and come back. There is no halfway house. You can bury your head in the sand and give your money to a wealth manager and get even lower returns. But the big money, what you're paid for, is your stomach to be able to get through it. Now, where are we at the moment then, Alpesh? Tell us what to do. Where do you think you are? What are you doing? Well, I'm still in, because we haven't started dipping. Well, Alpesh, you should just trade in and out. No, I'm not trading, because if I was trading, I'd be going in, out, in, out. This isn't a trading portfolio. It's pensions. So that's where we are on the S&P. Now I'm going to show you something really clever. Do you see this? What you've seen, you might want to take a picture on this. Those are the support levels. Okay. Now, if we break through below that intermediate support, then which is roughly at 7,200, and currently we're at 7,300. Okay, so if we go, then you go below 7,200, you're going to go to 7,000. All right, near as damn it. And if you go below 7,000, then I'd probably say you're going to go to 6,800, which is only where we were in April anyway, but it's going to feel painful. Let's have a look at what that's going to feel like, right? Let's just have a look what that might feel like. Well, that's only a 6% drop from where we are. But people are going to say it's going to be the end of the world. Now, do I think that's going to happen? I don't care whether it happens or not. In fact, I hope it does. I really hope it does. The reason I hope it happens is because then there'll be a whole load of good companies that I've got, which I can buy back even cheaper. Why do I want to buy them even cheaper? Well, because I know that these are the kind of companies which are going to make all-time highs in the future. So if I'm buying them cheaper, all-time highs that they've already made, if I'm buying them cheaper, I've got locked in again. So if they've dropped, say, for argument's sake, 25% during a fall, then I know I can make 33% gains locked in, even if that takes a year or 2 years. 33% over 2 years is fine. So I do hope it drops, because I'll only buy the kind of companies, we'll go through some names, which I'd be happy to be in that position, to be put in that position where if it falls, then I'm more than happy to buy more of them at that lower, cheaper rate. Okay, so some of you might, if you're into these chart positions, say, well, wait a minute, isn't that, Alpesh, like a Head and Shoulders? Aren't we really going to get? So I'd say bear case, we're going to get to 6,800. Okay, bear case. Am I going to panic? No. Do I think it'll happen? Well, I hope it does. I hope it does. It's another 4% lower, because that will mean 4% on the index will probably mean about 20% on some of the stocks, which if they're dropping 20%, I've got a 25% gain locked in. Okay, that's how I look at it. And I think that's a very sensible way to look at it as well. Right. So we're going to look at that. I don't look at narratives. I don't try and look inside the president's head. That's stupid. That's called gambling. Stupid waste of time. If you spend your time on X or trying to understand what the president's doing, well, you've got more time than sense, I would have said. But what I think you ought to do instead is actually look at the prices and what people are willing to buy and sell at, because that's the truth. It's the only truth there is. You know, everything else is bullshit. Oh, I think Trump's going to do this. Well, I think this is going to happen. I think that's going to happen. What are people willing to buy and sell off? Otherwise, they're just yakking off. All right? Prices are the thing that matter. Now, this is the monthly seasonality board that we've created for clients. We've not made it available directly yet to clients. I'm still providing this to them, but they're going to have access to it very shortly. That's Alphabet, 10 years of Alphabet. June tends not to be a good month. Why do we look at this? It's not to trade. It's yeah, we expect June not to be a good month. We expect July to be. Now, if you want to trade, go ahead, be my guest. I suggest you don't do it. A, you'll mess it up. B, you won't have the time for it. C, you'll mess it up. D, you'll mess it up. Okay, so June, we expect it. This is in the case of Alphabet to be a down month. So we're not going to be panicked or worried when it happens. Okay, over a rolling 21-day period, actually, June can be quite a good time to hold through the month and buy during that month, because it ends up being a good period getting into July, into it, right? July tends to be the best possible month for monthly returns. This is not for trading. It's just so we know, we get a better idea of how things look on the dashboard. I showed you this last time. I was at JP Morgan's private bank event, and this was a closed room event, and this is what they're telling their wealthiest clients. We know this because it's the private bank division, and this isn't the stuff they're going to put on the internet. Don't overreact. Geopolitical shocks test markets, but don't define them. That's what they would say, that, wouldn't they? Yeah, well, if they want to stay in business, they better say what they really do think. Otherwise, they'll be bust very quickly. And they managed to do it fine so far. So it's worth taking a note. The reason I showed that is not because I agree with them, more that they agree with me. I don't have a problem with what they've written. If I thought they were completely wrong, I'd say so. And very often on press TV channels and so on in the past, I have said so when I thought somebody was absolutely wrong as well. Okay, we've got quite a few questions that are coming, but I will go through these and answer them shortly. Now, market outlook past the 7,600. I didn't write this. That isn't me. That's Goldman Sachs. That's what they think by the end of 2026. And when we get that slightly bigger perspective, you get an idea that actually a day feels like panic, but 6 months out feels like, well, I can be relaxed. And these are the reasons why. Now, I was at London Tech Week this whole week, and we had a whole bunch of companies there. And I looked, and I've got some videos I've recorded, which I'll put up on my Telegram and my TikTok. Virtually every company was mentioning AI. There was one picture I took where on the photo, you could see on one side Dell and NVIDIA. They've partnered up. So it said Dell-NVIDIA. And NVIDIA have got this thing now whereby you're allowed to use their logo. It's become a brand name. Like, you remember when Intel Inside was a thing 20 odd years ago, 30 years ago? Now it's, if NVIDIA's written there, people think, well, that's good. Dell, NVIDIA, AMD, I had in shot. Amazon, I had in shot. So I had a whole bunch of companies I own in the picture. And JP Morgan were there on one side. And I thought to myself, wow, okay, can't be doing too bad. And every single one of them had AI, or they were talking about AI. They might say, well, there's a bubble, Alpesh. Fine. And this is what I tell people. If you think it's a bubble, then stay away. We created a model portfolio for a client who said, I don't want tech stocks because I don't want the volatility. I said, fine, but don't expect tech stock levels of growth from Costco. Okay, so we created a lower volatility portfolio for him, under 10% drawdowns, but then the gains weren't annualizing at 50% per annum. They were annualizing at about 25% per annum. No guarantee that would ever happen in the future. No guarantee at all it would ever happen in the future. And then he can pick and choose from those, whether he wants those or not. That's his choice. We don't. We do it for education, information, so that it can make an informed choice. We don't manage their portfolios and I'll give them advice on what they should do on those. But at least he was better informed than he started off with. And again, I'm not a salesperson for NVIDIA. Whether you buy it or not, I could not care less. What I care about is that you don't make stupid mistakes by buying stocks with greater volatility and drawdowns than you're comfortable with. So what are the risks? Well, valuation is one risk. There's always on a dashboard risks no matter what happens in a market. Valuation to some extent is, but earnings are growing significantly. So whilst prices are rising, price to earnings, in other words, the top part of the ratio is rising, prices, but so are the profits. And often they're rising faster than the earnings. So to the extent some of the stocks are ridiculously cheap. I guess a bigger concern is the market breadth. Is the market too narrow in its rises? So we looked at this. And what you can see here is market breadth, S&P 500 companies above their 200-day average price. So the average price over the last 200 days, are they even above that? Because if too many get above it, the idea is you'll get a reversion back to mean and a pullback. So if you're too high up, you could get a fall. Now, do we see that at the moment? Not really, no. I wouldn't read too much into it, but no. Market breadth also, S&P 500, net high lows. So the net number of companies, how many are more above all-time highs versus all-time lows. So what's the breadth again? And you want to avoid sort of extremes on this. I'm sort of in the middle there as well, not much to tell. So am I worried at the moment? Either way, no. So I'm more than happy to hold. There's only 3 decisions to make: buy, hold, or sell. Would I buy more at these levels? Cautiously, but I'm always cautiously buying. Hold, yeah, because I don't have a reason to sell. Sell, not quite yet. Not until, at least on the monthly MACD, we get that into a mummy bear, would I even consider talking about it. And I don't like to think about things before I need to think about things. Otherwise, I've wasted my time thinking about something which I didn't need to think about. And the processing power is limited. So I don't want to be wasting time. Micron, 1 trillion mark. First time stock went up 19%. If you're getting that kind of stuff, of course, you're going to get 2 kinds of people. You're going to get the ones who are going to say, well, should it be in my portfolio, but maybe 1 of 40 stocks, 2.5%. You're going to get others saying, nah, absolute bullshit, don't want to go anywhere near it. That's fine. I'm not a salesperson for Micron. The fact that I own it, and I wish I owned only this in hindsight, but hindsight's a wonderful thing. So what do we have? Instead, we have 2.5% of it, which obviously, because of its big rises, now represents more of my portfolio. I think it might be closer to 10% now, and I probably need to take a bit off, trim a bit. I might not go all the way back down to 5 on a rebalance. I might just trim, just keep it at 10% floating for now. Not sure, but it depends on my risk appetite. But as long as there's boundaries, I don't want it to become 50% of my portfolio through its profitability. Okay? She doesn't look happy, obviously not a shareholder. Goldman Sachs raises its S&P 500 year-end forecast. Bit late, mate. 8,000 now. It was 7,600. They said 8,000 because of a boom. Let's put all of that into context. Obviously, they've got to raise it to 8,000 after the bloody event. 7,600's there. They've said that. Now, they think by the year end, it's going to go to 8,000. What's that on a percentage basis? Ooh, it's a bit off the scales, isn't it? It's about another 10% from where we are today. Now, 10% more from where we are today. That's a big rise for a lot of because don't forget, indices don't move without companies moving off the companies. That I was at the Oxford University Forum that JP Morgan Private Bank had, and I've shared some of the insights with my clients on the Great Investment Program. I guess the main thing I want to get across to you is this: the chief scientific officer of Goldman Sachs of GSK, GlaxoSmithKline, getting my letters mixed up, was there. And he talked about their scientific approach. And it's really the scientific approach we will use in investing as well. You take the data and then you test it to see does this hypothesis make sense? Are the markets going to go up because they're at all-time highs? Are they more likely to fall or rise? Or, it's a Tuesday afternoon. Are they more likely to rise or fall? Or it's a Thursday afternoon or whatever. Not just, well, I wonder if we drink paraffin, we can cure cancer, right? The scientific approach is what we also use in investing as well. California. Hi, Richard. Thank you very much indeed. JP Morgan had provided during that an insight onto SpaceX, because one of the worries people have is to buy into SpaceX IPO, people are selling some of the profits of the tech companies. And JP Morgan said that's what they're seeing. But given that the SpaceX IPO is taking money from all around the world, not just America, taking money from people who won't even have the Mag 7 stocks, taking money from retail clients in Britain, Europe, wherever, and given it's only $75 billion at $1 trillion valuation, $75 billion, and given the volume of the Mag 7 companies, whilst it will lead to a dip, the kind we're seeing now, which they anticipated when I was at that Oxford Forum 2 weeks ago, they don't see it being anything other than a buy the dip opportunity. Now, you might say, well, of course they'd say that. They're not going to say to people, get out now. You're right. So we got a discount for that. But as things stand, I'm not particularly concerned enough to move from hold to sell. That's the only decision I have to make. You try and make every single decision into binary. You know, the thing about it, you're picking a tie to wear for dinner. You got 50 ties. Eventually, you and I both know we'll just narrow it down to 2. And, a bit like the World Cup, you eventually get down to a semi-final and you say, right, and then a final is between these 2. Okay, I'll go with the blue tie. And similarly, the decision becomes binary. Am I holding or am I selling? Or in this case, tertiary, binary, buy, hold, or sell. And at the moment, from the positions we've got, we're holding until we'll see if there's a mama bear and we might look at something. But the main issue is we might rebalance. And that's what Warren Buffett often does. But people mistake that as, oh my God, he's selling. No, rebalance is just the sensible thing of you've got one stock, which is now 50% of your portfolio. If I take Seagate, Western Digital, and Micron, they might be 30, 40% of my portfolio. Of course, I'm going to rebalance because I don't want 30, 40% of my portfolio in 3 stocks. Why not, Alpesh? Well, in hindsight, maybe I shouldn't rebalance. In hindsight, I should have just owned any one of those 3 or only those 3. And maybe the same for the next 12 months. But I don't want that kind of volatility because at 54 with an 8-year-old child and a lifetime of work, my job is not to F it up. I'm thinking, what are my grandchildren going to be inheriting? Okay, so I'm very different and everybody's very different. You might be thinking completely differently. So that's the reason. So here's the reasons they gave in terms of why they're not particularly concerned, why they're seeing money going into the UK markets as well, because it's now a diversifier away from the tech side of what America's doing. What Europe and Britain's doing on the deep research side is different. We're not actually competing with the Americans, we're complementing them, but we're not competing with them. Okay. And again, we live in a world where, so I don't check my portfolio daily. I mean, people seem to think that I might be glued to it. I couldn't even tell you all the stocks that are in it. I know it's one of the model portfolios we've got, and I know, but I haven't memorized every single stock that's in it. So I'm going along and looking. I happen to know Marvel's in it. I'm looking at this. And in one day, it was up 32%. Now, I've been involved in investing for a long time. And the only time I'd see stupidity like this is on the dot-com boom. Does that mean Marvel is a bubble? Well, just think about the irrational logic of saying it went up 32%, dot-com stocks went up 32%, therefore it must be a dot-com stock, therefore it must crash. No, that's stupidity. That's not logical. It happens to be a profitable company. The stupidity I'm talking about is just how bad the market has to be. Think about how bad and poor the market has to be that it can't even price a stock correctly enough, that 1 minute it's at 290 or whatever, the next minute it's up 32%. Which just shows you, if you think the markets are rational, you're wrong. If you think they're efficient, you're clearly wrong. Jim Simons, whose book, or his biography, I'm reading for the 50th time because it's brilliant. Most successful hedge fund manager of all time, most successful fund manager of all time. Put it this way, and again, they use very much mathematics. They look at the data and then they say, does the hypothesis follow? Private investors, unfortunately, look at stories and headlines and news and all the rest of it. This is the NASDAQ, and this is, again, the dashboard we've created for clients of the Great Investments Program, which we're going to make available to them very soon. And what does the NASDAQ do around this time in June? Well, actually, June tends to be positive. It's not too bad. July tends to be positive. We're not in a bad period at the moment, June and July. Okay? It's not bad at all. And so I'm not worried. Now, 2 days ago, I interviewed the Minister for Investment, appropriately enough, given that I've got the Great Investments Program, Lord Stockwood. He grew up on a council estate in Grimsby and built a company called Simply Business and sold it for 500 million. And we went through just the elements of what made him successful. And what was interesting is something which has often been said in the world of investing. Luck. He said luck. Now, that doesn't mean you throw darts at a dartboard when you're picking stocks. But what's been lucky for me this year? It's not been that I owned, say, NVIDIA or AMD or Applied Materials. What's been lucky is that somebody else invented artificial intelligence and they used those companies' products. But you might say, well, no, you only picked those companies because you saw their profit and loss accounts, their profitability jumped up, their cash flow jumped up, and all these things. So you put yourself in a position to be lucky, which is also what he said. And it's amazing how the things which lead to success in one area are actually true of all areas. How did I put myself in a position to be lucky? Well, I'll tell you how I put myself in a position to be lucky. Well, first of all, I made sure I knew about things like this from Goldman Sachs Wealth Management. Depending on where you are with age, the more you hold in cash. Well, that's the easy bit, but I'm just going to show you I'm going to show you the unfiltered bit, because clients get the filtered bit, which is the important bit. But the unfiltered bit, none of these companies make our portfolio. So was I lucky that Applied Materials was green across all these 5 columns, and that's why we owned it? Well, it was green because it produced great growth, profitability, revenue growth, profit growth, cash flow growth, and hence momentum. And it had very high Sortino. In other words, the dips were shallow and rebounded quickly. Was I lucky? Well, no, we were looking for that. But the level of rises, 100%, 200, 300%, we have no way of seeing that. That was the external environment. That was down to artificial intelligence. We didn't see that. We didn't invent it. So we put ourselves in a position to be lucky that these are the kind of companies which should profit because they're clearly good in the sense that they're good at generating profitability. Their management is revenue growth, dividend growth, and then something else in the external environment, artificial intelligence, led to demands. Okay? So we put ourselves in a position to be lucky. And then the luck bit was that the world wanted AI. And it was exactly the same in a way of what he's saying. And that's how you get to the big bucks. For those who are clients who are watching this, don't forget we've launched the Great Investments Program Private Circle, calling it the allocation room because it's a sexy little room where I will go through market insight perspectives and give you institutional insight out of what the big hedge funds are saying and doing as well. So 6th of July, if you're on the program, you'll have seen this on the private Telegram channel. Okay, so where is the S&P? As I said, fairly flattening. Worry stations, not at the moment. Oracle had its earnings, Adobe, these aren't big. I mean, Oracle to some extent is big on the earnings calendar. If we take that into news items and what's important, well, Defense Secretary isn't important. SpaceX IPO draws more than $70 billion in retail orders alone. They're only selling $75 billion. Retail globally has asked for $70 billion. Knowing Musk, the greed will be too much for him. He'll probably do another issue at an even higher valuation because he's now in that unique space where he can do anything. The man drops, then that company's going to zero probably. So if you've got in pre-IPO through a broker, fine. But this is not the usual way in which we invest, and maybe hold it like you do your Bitcoin for your grandchildren. If you're trying to be a stag like the privatizations in the 1980s, which is where I cut my teeth, if you're trying to be a stag, then you'd sell pretty quickly. Straight after if you're in a gain. And if you're not in a gain, say of 100%, take your original money out. And if you drops 50%, maybe you'd buy some more. And that's it. IPOs is not our specialty. I've not done them since the 1980s. But if you're in it because you just don't want to be out of it, then that's the way you'd do it. And for all I know, the crazy demand, who knows? This damn thing could go from $1 trillion to 10 trillion in a month. There's so much money out there, and there's so much stupidity out there. People will just buy off the back of that. Most people don't even know what it does or doesn't do. Okay, where else are we on the news? Falls most in 6 months on mounting data center costs. We're at that time where it's a couple of months of, oh my God, data centers, AI, will they ever recoup the cost, to, oh my God, AI is just amazing. And we're going to flip back and forth. So my Oracle holding still there. Couldn't care less. I didn't even know that it had fallen yesterday. And that's actually the same attitude that Warren Buffett has, which is we're not there to sort of look at every single minutiae of moves on these. That's the past week and where the markets moved. Broadcom, 18%. Now, you can see the temptation is, if it drops X, I should sell Y. I didn't even know it dropped 18%. I was busy interviewing the minister. Microsoft, 8%. If I was trading, then I couldn't have done anything else in my life other than be in front of the screen and say, look, if it drops 10%, sell 30% of it and then buy back and all the rest of it. We don't do that. because we're here to invest. So if we're here to invest, that's the price of admission, that you will have those kind of big moves. Does that mean you just shift into healthcare? No, it's a bit late now, isn't it? Because what you've got to remember from this webinar is you're not trading. If you're not trading, what happens in the past week or the past day is completely irrelevant to you. And if you think you want to trade, well, try it with £1 or 10 or 100, but don't do it with your life savings. The biggest mistake I see private investors making is they start trading their pensions because they're trying to be right on every investment. Warren Buffett got right, not by being right on every investment, by having periods where every stock in his portfolio dropped, periods where there was no year where every stock had gone up in his portfolio, periods where he had 50% drops in his overall portfolio, let alone individual stocks. And every single year, I think, out of any 3-year rolling period, there was at least one stock that had dropped 50% in his portfolio since he started investing, at least one. And that's with somebody who's supposed to be amazing. Okay? That's been the past year. Now, over the past year, in hindsight, I wish I just bought AMD and nothing else, but I didn't. I wish I had SanDisk and nothing else, 3,800%. Now, that had become overweight in the portfolio. In fact, it's one which is in our model Quality 5 Plus. And I barely mentioned it because I didn't even think it was going to do something like that. I mentioned the ones in the headlines because that's the ones people want to hear from. And so it's sitting there in my portfolio, I'm looking at it, I'm going, bloody hell, that's like 15% of my portfolio now, 30 or whatever. Better start easing back. Okay, or WDC, or Dell. Actually, anything in here, really. It's computer hardware. Did incredibly well. So what are we doing with those? As I said, you can either rebalance annually, rebalance during the year if any of them become more than 10% of your portfolio or under 2.5%, or if it drops X, sell Y. The other question of would you buy it now? Well, as part of the model portfolio, not individual stocks. Why? Because as part of a portfolio, and the portfolio level is what you should look at, it's what Warren Buffett looks at, your portfolio, because it's dampened by stocks that go up and down, you don't have panic stations. If you say, should I buy Micron? Should I buy SanDisk? Depends what else is in your portfolio. If nothing else is in your portfolio, you should not buy Micron. Because you've got nothing else in your portfolio. It's the only thing you're buying, and it's too volatile for you, and you're going to throw up because you're an 80-year-old grandmother. Do you see the context being important? So if you look at the portfolio level, yeah, these are fine, because within these, we've also happened to have a JP Morgan and a Goldman Sachs. For instance, well, that was rubbish, Alpesh, because JP Morgan's only up 17% over the past year, and you could have just put it all in SanDisk. Why didn't you know? Well, I didn't know of those two which would go up the most. Neither did Warren Buffett, which is why he doesn't just have one stock. Imagine a man with all that money. Buffett became the world's richest man, doesn't just have one stock. Surely he can foresee the future. Even worse, with all that money, never had a year where every stock went up. And yet private investors are trying to be even better than every single hedge fund in history, every single successful fund manager in history, let alone the ones which aren't unsuccessful. They're trying to be right on every single pick. And they're saying, I don't ever want to be wrong, and I want to try and pick the tops and the bottoms. Absolutely insane. Whereas a professional saying, I'm not trying to pick a top and a bottom. I'm not trying to be right on every pick. That's why I'll have a portfolio, either 20 stocks with 5% in each or 40 with 2.5% in each, and the rest in cash. And the amount of cash will be held depends on my age. The older I am, the more the cash I'll hold, because the more certainty I want in life. If I'm 90, I'll probably have everything in cash. Not me, but somebody else. And speaking of which, if you want to work out, well, how do you decide? There's two great free resources I've created. First of all, the blogs, but just as good as those, the tools, okay? The tools that I've created over there. And the reason the tools are so good is, by the way, 58% of you think the FTSE will be higher in 12 months. I'm going to do another poll with the US markets and how many of you think. The tools I've created are really great, because one of the biggest problem people have is, how much do I need to retire? When can I retire? And what's a safe withdrawal rate once I've got to whatever age? And this allows you to play around with it. They're completely free. campaignforamillion.com/tools. Okay. And you can look at the volatility of your portfolio, assume 15% because that's standard. And you can change and play around with the growth rates. And what this will teach you is, you might think, wrongly, because the journalists and the vested interests in wealth management will try and convince you just save more, save more, save more. And it is always good to save more if you can, okay? Because they earn more money if you save more money with them. Because what they're actually saying is give us more money, which means give us more fees. But what you'll learn when you play around with this is if you can improve the growth by even a tiny point, it can make a massive, massive difference. And the easiest money is not the money which involves you retiring later, because that means you've got to retire later, or saving more. That means living poorer now. It's the growth element. There's only three things which can move your pension: retire later, save more, or grow better. Growing better is free money. That's why my focus on the program and through all the books and my Financial Times columns, my Bloomberg TV shows, has been on growing the bloody capital, not saying, hey, why don't you just save more and retire later? Because that's the bit nobody actually would want to do, okay? Except your wealth manager. They want you to do it because they want to lock you in. So if you're in a pension wondering why the hell it's not growing, have a look at that as well, campaignforamillion.com/tools. So that's been the past year, and that's pretty bloody good. And if we get a repeat of that, even if it takes 2 years to get a repeat of that amount of green and those amount of digits on there, I'll be happy. And I think over 2 years, we can get that. Exchange traded funds, I'll do in a separate webinar, just because it's a separate topic. So how are we doing over the past year? Well, 33% is what the NASDAQ's done. And that's a rising tide. A rising tide raises all boats. So yeah, we got lucky that there was a rising tide, as there was last year and the year before and the year before that. That's the luck bit. How do we put ourselves in a position to be lucky? We were involved in the bloody stock market. We're managing our own investments, not giving it to flipping St. James's Place to piss away. Okay? So, two things to making money: putting yourself in a position to be lucky, and then the luck element. The first one's in your hands. The second one isn't. The first one, which was in our hands, is we're involved in the stock market. The second one, which wasn't, is the stock market soared. That's not in my hands. Okay? And how do we get the stocks to put ourselves in a position to be lucky? Well, we listened to our own advice and said we want companies with good valuations, i.e. lots of profits for their share price, high dividend yields, good cash flow, good revenue growth, good momentum. All of these first 5 columns had to be green. Sometimes my clients see this and they go, why did you show the filtered list, the approved list? I'm not. I'm showing you the ones which didn't qualify. None of the ones I've shown on screen qualified. The ones that qualify is here. Okay, if I click that little tab, that would reveal what the clients get to see. Okay, and out of 10,000, let me put it this way. It's easier to get into Oxford University or Harvard than it is to get into my portfolio. Actually, it's easier to get a Nobel Prize in economics than it is to get into my portfolio and get on the approved list. We go through 10,000 securities. There's only about 150 odd, which would be good enough on value, growth, income. You know why? Because I'm feeding my son this. I'm not going to feed my son something out of what a journalist has said. Okay. You know why else? Because when the luck comes round and the market goes 33%, I want to be in a position to be lucky and have that ready. There's famously been said, success is opportunity meeting preparation. The opportunity was that the market went up. The luck, that was out of my hands. The preparation was we had the data ready. Now, when it happens, we'll benefit. These are just some of the US stocks, not necessarily ones I own, but just giving you a flavor of what's going out there. I don't think price earnings ratios for a tech company of 27 multiple is that bad. I think 41 for a retailer is expensive. Okay, these are the UK ones. Again, not ones I happen to own, but just giving you some idea of what's out there and what's things have been doing. A bit of a mixed bag on the UK side. NASDAQ, almost ballistic. Obviously can't continue at that rate of growth. We'll have pullbacks. But what you want to look out for, and here's the clever thing. Okay, what you're actually looking at is the longer term trend growth. And the longer term trend growth for now has been that. So don't be surprised with a pullback and maybe even an overshoot below like that. What will we do? Well, we're not here to trade. So we'll expect it. And that's why the great thing about the Great Investments Program is you've effectively got a mentor to hold your hand so you don't panic. AI can't give you that mentoring. Okay, because it needs a human touch. FTSE 100. Okay, that's a mama bear because that's falling. It's not a daddy bear because it's not calling through there. So mama bear, would you panic and get out now? Probably not. It's overbought, but it's got its own little foibles, which is leading the FTSE to continue higher. Would I buy more? No. Whenever this is falling, I wouldn't ever buy any security if the monthly MACD is falling. So no, I wouldn't buy more now. If I'm already in it, would I hold? Yeah, because it's not a daddy bear. Would I sell? No, because it's not a daddy bear. Simple decisions. Make them simple, becomes easier. Gold, bit of a pullback, bit like NASDAQ. Now, is it about to crash? Not from what we're hearing from every single person, from refiners to banks that we're speaking to. However, that pullback's not a surprise because that's the longer term trend. And don't be surprised if you get this. When it falls below that longer term trend, people might panic. If it falls below it at 24, would I buy it? No, because I'm Indian. We've got enough physical gold. Thank you very much. I don't need to. And I'm not here to trade. Simple. Decision made. Move on. Bitcoin. Now, we've said for a while, actually since, February, that if that holds, you're laughing. But the danger you have is the monthly MACD. And indeed, the monthly MACD, as it often does, beats the weekly and has fallen. So is that going to fall below 60,000? I probably think so, yeah. Would I buy more? No, I've got enough. I don't know how much I've got, but I think I've got enough. I don't need more Bitcoin because I don't want to be overexposed in any single security because I'm not here to trade or gamble. If I'm here to trade or gamble, I'd go and do that. I'm going to have to go in a second because I've got a client waiting for me. Apple, overbought. A lot of them are like this. They're a bit overbought. What do you do? Well, it's buy, hold, or sell. Would I buy more? At the moment, it's going sort of sideways and it's overbought. No, and I'm happy with what I've got. Therefore, I'd hold. Do I sell? No, no reason to sell. Okay, so similarly with Alphabet, makes it pretty simple. Similarly with NVIDIA. Oh, but Alpesh, it's going to fall. It's got a bearish divergence, lower highs. Yeah, it will fall because it often does fall 20, 30%. I hope it does. But I'm not here to trade. So I'll hold what I've got. And if it does drop that kind of level, I might top up more without being overly exposed in any one stock. These are just for clients. So we'll leave all of those. Okay. We created a very concentrated AI semiconductor quantum portfolio for a client who wanted a very specific portfolio. It's up to them whether they buy or sell it. It's just to educate them on how these things move. And what we wanted to educate him on was this, that you can get great returns, including 2022, where the markets fell 25%, but you will also get severe drawdowns. And that's what technology does. And most people can't take that. I wouldn't want just that. I built this for my sister in Nashville, and it had this many companies, as you can see. Okay, and you can see that there are some years where you get massive losses. Now, she's the type who's not going to look at Daddy Bear and exit in 2022. She's going to have to sit through it. She might not even look at it and realize that that's what can happen when it repeats itself. But unless you can take those kind of numbers, so that's why we show those numbers for that transparent education to clients to say, look, are you happy with this? If this repeats itself, and assume the worst will happen again. And if they say, yeah, then they've got something. If they say no, then you'd want to look at more dilutative or diversifying securities. We take 10,000, you put it into that. That's the job. Okay. Now you might be a self-employed professional, might be a business owner, you might be a DIY investor or a retiree. Essentially, you've got the same problem. How do I get a simple process which will help grow my pension better? And for that, the process and the education, that's where we come in. So if you're interested in the program, that's where you go for the Great Investments program. By the way, so it's alpeshpatel.com/shares. I just want to, while we do that, while people look at that, I want you to just show you some of the news items. Now, yes, it's all about SpaceX. Could the SpaceX IPO cause a major problem in the market? I think it's going to cause that by the dip issue. I don't think it's going to be something which would lead to panic stations. Now, I don't have a problem telling you the way it is, because whether you're in the market or not, I'm not your stockbroker. I'm not your fund manager. I don't charge you 1%, 2% of your fees. Whether you're in or out makes no difference to me. Okay. I have no vested interest in it. So I can just tell you it the way I see it, which is at the moment we'll get a bit of a dip, but there's enough capital out there to absorb both SpaceX and everything else. What you've got is you've got OpenAI coming and a bunch of other ones after that as well. And that might put even more pressure, but every time that happens, there's going to be pressure on the markets. If we look at what we've got here in terms of what's happening in the markets, okay, now I happen to own KLA, all right, up 8%. Lamb, I didn't know that was up that much. I don't have EchoStar. Oracle down 10. I happen to own that as well. Swings and roundabouts. Do I care on a day-to-day basis? No. And if you care, I have Applied Materials as well. That just moved in there, didn't it? Okay, so it's been a good day for those three. Do I get excited that that's happened? No. Do I get pessimistic that Oracle's dropped? No. Would I buy more Oracle? Probably not yet, because 10%'s pretty quick, pretty frequent that can happen. Those numbers, again, that I wanted to show you. And the reason we show clients all of this, thank you, Jeremy. I'll get an email that you signed up, and I will send you a note in a second. Thank you for the private message on that you signed up. So what happens with this on the S&P and the like is that we're not looking at this to trade. We're looking at it so that it doesn't cause panic. Panic and boredom are the two worst things that constantly happen to private investors. That's the problem. Thank you. We've got a couple more who've signed up, and I've got your emails. Thank you very much for that. And I'll send you an email on board. You give you access to all the database, and then we'll have our first onboarding call as well, because that'll be the next step. I've got a lot of questions from people, which is fantastic. What I'm going to suggest you do is if you email me the questions, okay? Cutting IFA costs barely helps because you're cutting a cost from 0.5% to 0.25. Whereas if you can increase growth by 1%, that's significantly more than cutting an IFA cost. And part of the problem is the hidden cost of the IFA is poor growth. So it's not, I cut my fees by £25 a year or 0.25%. The problem is they've not given you the growth you could have got yourself. So they've actually hit your portfolio by about 10% in growth. You don't see that. You see the fee because that's something taken out of your account. You don't see the opportunity cost that you didn't grow by an extra 10, 20, 30%. So that's the problem with the IFA. Cutting IFA cost is the distraction. It's looking at the wrong thing. Okay, it's saving the penny and getting screwed on the pounds. So be very careful about thinking that, I saved 0.25% in IFA costs. Wow, it's really helped. No, what you've missed out on is the significant gains. And the IFAs put it into the funds that they're out to promote, and those funds spray and pray into a narrow category of stocks. They won't give the 20 which you want or the 40 that you want as well. alpeshpatel.com/shares. Thank you, Dharmesh, for asking. alpeshpatel.com/shares. There's the link, and it should pop up on the screen as well. 74% think the S&P will be higher in 12 months. Who knows? All I know is I've got the kind of stocks that if it is, I'll make more money. If it isn't, there'll be the kind of stocks where it's just deferred my gains because I'll buy more of them, or even if I sit back, they're the kind of companies so either way, I win. Heads, I win. Tails, I win. Because either the market's up in 12 months, in which case, obviously, I win, or it's down in 12 months, in which case, they're the kind of companies which will go back up and go back up significantly because they're the ones with the highest Sortino ratio, the highest average returns versus lowest downside risk. Okay, so that's been past years, but that's just the January one. Obviously, we have model portfolios for each individual client, bespoke to them. That's just January, and you wouldn't necessarily want the same things that everybody else wants. So on the news items, we're back up again today. Okay, well, the Nikkei is in any event. That's Asia. The S&P's up 0.5%. Dow up 0.72. Maybe all the selling's done because it's too late now to get into the IPO for people. So there's no more sell orders coming in. So the last 2 days would have been the worst days on the sell orders in any event. Okay, which sort of makes sense. Got to see if there's anything else. I want you to have a look at campaignforamillion.com/tools. Remember, that's where we've got all those special tools for you as well. We are, because I've been saying it quite a while and my team's been telling me and reminding me as well, given by how much people's portfolios have been going up who are on the program, it's time to raise the price of the program. Just as inflation is why you raise the price of bread or milk. Well, there's an inflation with the stock market. Last year, 40% up. Well, we should raise the price of the program by 40%, obviously. So that's coming. Raj, what's the minimum holding period for the approved stocks portfolio? Well, they're your stocks. You can hold it for a day if you want. We don't hold your portfolio for you. You hold it. We give you the data and the information. So there's a Raj model portfolio version 1, 2 or 3, whatever you're happy with, and then you buy them in your brokerage, and you might hold it for a day or a week. But I'd suggest you hold it for 12 months because you're investing, you're not trading. And if 12 months doesn't give it, let's say there was a bear market and you thought, oh my God, 12 months, I haven't got my big return, then I'd say you should be prepared to have a portfolio, well, for the rest of your life and your children's life and your grandchildren's life, obviously. But if you're looking at some kind of exit, I'd say I wouldn't want to try and target, oh, I need this money in 12 months. I'd say 3 years, great, because we're investing. You're not trading. If you're here to trade, you're in the wrong place. Rob, my role on the Tokyo has done well this last year, up 30 in 12 months. Which funds after signed up to your site a year ago? It was defaulted in balance. Well, yeah, defaulted in balance is so awful. 45 and way yet to run. But thank you. My pleasure, Rob, and I'm glad you moved out of the default fund. I've written many articles about why default funds are the absolute worst thing to have. So I'm glad you got that as well. Apologies, just join. No worries. Slower here in Norfolk. Michael, hi Alpesh. Looking at some key metrics, taking into account US inflation and the S&P 500 trading earnings yield, the real earnings yield of the S&P is now approximately -1, with inflation rising in the US, the S&P value being considered. We potentially have bubble territory now. There's a lot in there. What do you mean by bubble? I mean, that's the first thing to define, because what usually people mean by bubble is there is an increased probability of a sharp fall of 20%, 25% in a short space of time. Okay, such as in a month. Okay, those are the things you mean. So are we in that territory? No, you're not going to in a month get a 25% drop. Guaranteed. In the next month or in any month from now to the end of the year, you're not going to get a 25% drop in the stock market, in the S&P 500. All right? Guaranteed. Individual stocks can drop 25% in that period, 50%. Okay? It's not going to happen. What else does a bubble mean? It means that, say, a majority of S&P 500 stocks drop more than 90%, 80%, 75%. Obviously not just 10%. No, you're not going to get a majority of S&P 500 stocks dropping from where they are today to the end of the year more than 50%. So no, we're not in a bubble, because that's another way of looking at it and answering it in broader terms. Okay, I'm going to go because I've got a client meeting now. I want to thank you all. For those who signed up, thank you very much. We'll do a replay of this as well. Sorry it was short and sharp, but I hope that helps give you all the information you need and allays some of the fears that people have with markets as they stand at the moment. Like I said, I've got no axe to grind. If I thought the market was in a daddy bear, I'd tell you. And you know exactly what I would tell you, because I show you exactly what I see, which is I show you the S&P and I show you the moves. And at the moment, we're not even in what might be called a mama bear at the moment, because on the weekly, which is this one, okay, we're not falling yet. And I don't over anticipate it. I don't anticipate it in advance. Do I know which direction it's going to go? No, I don't. Oh, by the way, Alpesh, wait a minute. There's an issue with all of this. Look, that's what, the longer term trend? So it could easily drop below. Well, I hope it does. I hope it undershoots. Is that the way? Or overshoots on the downside. Maybe that's the correct language to down there. And I'll tell you what the ranges are if you want to see them. Okay, there you go. Isn't that a pretty good bet for the ranges on this? So if that's a good bet for the range, there you go. Another 9% down on the S&P. Alpesh, it's a bubble. It's crashed. Depends on your definition of bubble and crash. If your definition of bubble and crash is another 9% drop from today in, say, the next 3 weeks, then it's a bubble and it's crashed. That's not my definition, I'm afraid. It's not the market's definition. That's just a wobble. Otherwise, we just had a crash earlier this year and we had a crash last year. And I think you'd agree with me. No, we didn't. And we had one in 2023. No, we didn't, Alpesh. So you'd agree with me that that dropped. Now, if you're saying a crash means significantly more than that, let's take that little puppy, and that's going to go down, say, another 20% in a month or 2 months. Okay. Would I call that a crash? I don't know. It doesn't really matter then, does it? Because you're going to say, well, I don't care about definitions, Alpesh. So do I think it could drop to that? I think it could. That's only last April numbers. It happens often. Would you call it a crash? By that stage, nobody cares. But I'd make sure I've got the kind of stocks I'm bloody happy holding if it just drops to last April's figures, because then when it goes back from where it was last April all the way up 40%, boom, we make a killing. So first thing, make sure you're in a position to be lucky. What does that mean? The kind of companies which, if the market drops and crashes, they're the kind of stocks which shouldn't fall as far, but even if they do, you can buy more of, and then you'll make a